Hi, everyone, and welcome. We are so excited that you have joined us today. My name is Deanna Uzarski, and I'm part of our marketing and communications team here at Insight Partners. Now, today we're going to be talking about Insight's 2024 tech predictions. Before we get started, I have a few housekeeping things I would like to share with you. First, this is being recorded, so if you have to hop off early, you would like to share this with someone, don't worry, we're going to get the recording to you within the next couple of days. And then if you have any questions, please feel free to submit them in the chat throughout today's conversation. We received over 100 questions from you guys, and our speakers have woven them into the conversation. So we're going to be addressing a lot of those pressing questions that you guys submitted in advance. And then finally, there is a survey at the end, takes about 30 seconds. We appreciate if you fill that out. Without further ado, I'm going to pass this over to Hilary Gosher.
Thanks, Deanna. Welcome, everybody. Delighted to share some of our ideas with you this afternoon. So, Ryan, I know that you and I have been talking, and one of the books that I always think about at this time of the year is Scrooge, the book from Charles Dickens. But there's been another book that has really piqued my interest, another Charles Dickens book called The Tale of Two Cities, because there's a quote there that I've had a refrain running through my head most of the year. So let me start off with the quote, and then we can jump into the conversation. And the quote is something most people will be familiar with. It goes like this: "It was the best of times. It was the worst of times. It was the age of wisdom. It was the age of foolishness. It was the age and the epoch of belief. It was the epoch of incredulity. It was the season of darkness. It was the season of light." And so, Ryan, I think you and I would probably concur that the year hasn't had those polarities. It hasn't been only the age of darkness or the season of light. It hasn't only been the best and the worst. Certainly the promise of technology continues to hold, and that's what we're going to talk about this coming year. So let's start with what that promise looks like and what it looked like right back at the beginning of the year, frankly, where AI burst upon the scene. And one of our predictions for this year is that AI will go from experimentation to productization. And so, Ryan, why don't we kick off there?
Sure, and thank you everybody for joining. We're looking for easier times, desperately wanting easier times. As I know many of you, if you're operating companies, it's been a really hard couple of years, including the pandemic. And in capital market, it's been a really hard time. So pretty much anybody on this phone call is probably having some kind of experience right now that's been tricky. And we've also all had the experience of inundation with AI. And we're very careful. We don't want to make this whole session about AI, but it's hard to get through a board meeting without AI being a topic. And that prediction, it goes from experimentation to productization, means something like this. A lot of companies are talking about AI. In fact, the SEC just a few days ago issued warnings to make sure that you're not talking about AI theater as if you actually have a product. They're calling it AI washing, kind of like greenwashing. It's the same mindset. And it's kind of what this quote gets to. It's like, are we talking about AI because we actually have an application? Or did we just integrate ChatGPT into some kind of a search feature and said we're AI enabled? We have to take a little bit of a step back on what AI really even is. We act like it's a brand new thing. And I want to decouple what is new from what is not new. In the 70s, a lot of the math that sits beneath the machine learning, it was postulated as possible, but we didn't have compute power big enough and strong enough to actually do anything with it. And the whole big data revolution that's really been happening for over a decade now was the beginning edge of taking unimaginable data quantum and unimaginable compute and doing stuff with it. That stuff primarily was like when you're on Amazon and it says people like you also bought this. It was a direct application of AI ML concepts to make suggestions. And the big bang of this generative AI moment is that we can now leverage these capabilities to write human understandable speech, or even cooler, computer understandable code. And so we're taking what used to be a match the picture, and we're getting instead a make a sentence or a set of instructions and statements. And so, okay, what do you do with that? Experimentation, having some fun little features, really driving it into production. That's the spirit of what that quote gets to. And we know a lot of companies are experimenting radically for specific purpose uses. Instead of write me anything, it's, well, how do I maybe analyze a series of health records and make sense of the timeline so that I don't have to read through it? Or how do I understand a cost to fix a vehicle when I see accident history and have to interpret what it means? Things like this that are getting far more powerful now that they can write responses instead of make modest suggestions. So Hilary, I'll let you kind of poke and prod if you think I'm missing any key pieces.
Yeah, well, I always think about the Wright brothers, when they took off for that first flight, that first 100 yards, not even they would have thought that we'd be crossing the transatlantic, and the way that we would fundamentally, or the aviation industry would just fundamentally disrupt commerce. And I think that's what we're seeing, and we're only at the inkling of maybe that first 100-yard flight, only 10 feet in the air. But maybe Ryan, you've talked a little bit about productizing AI. Perhaps you could give some concrete examples from our portfolio, because I think about it in two ways. There's what are our companies doing around building AI into their product to make it more valuable for their customers. And then there's what are our companies doing to leverage AI to run more efficient businesses. And maybe we could talk a little bit about how that's coming to fruition on both of those.
Yes, I'll use two kind of conceptual examples. One of the companies I work with provides content management solutions. So how you power your website. And the idea of powering a website is you want to give marketing control of what shows up, what doesn't show up. And if you stopped there and said all content creation is their problem, that's fine. This particular company, which is Optimizely, for those of you joining from the Optimizely family, has an offering where you can pay money for a freelance writer to write you a story. That costs an amount of money. Well, the AI reimagination of that is you can put in a prompt and that story can be written to get started for you. And that's not a turnaround overnight. That's a turnaround over the time I've been speaking in this one sentence, 4 to 5 seconds. And it's an example of creating more power from, I have a platform, I have a known use case, content must get into it. How can I leverage a tool like that to create more content? That's a specific example. A more generic example, if I have a human intensive process somewhere in my system, and I can describe in words what I want that process to look like. I want you to remove all of the green M&Ms as they come off the assembly line. That's what I mean by describe the process. Well, we can use these generative AI tools to do some of that work, and we can actually amplify what's possible for a single human to do. And I'll use the example in a healthcare use case. We're investors in a company called Hinge Health. It helps you with joint rehabilitation. And the iPhone can look at you and see if you're moving correctly. And it can feed that. 1,000 people can be doing that, and one therapist can be watching and pointing exactly to the people who need to tweak their motion, because what it's important is doing the technique correctly. And if I was sitting one-to-one, I could, of course, tell you if you were doing the technique correctly. But if I have this tool to point me who needs help, I can be more efficient with that. So something that you can describe succinctly, you can help train AI to assist. And I'm a personal believer in the centaur version of this. It's not the machines taking over, and it's not get rid of the humans. It's how do I take the human capability and amplify it, almost cyborg style, like amplify the human opportunity set by making us faster, better, and less error prone, but keeping the most important part of humanity, the judgment, embedded in what we're doing.
Yep, makes a lot of sense. And talk about some of our other companies where internally they're using AI to drive greater efficiency in their operations, making customer success agents more effective because the LLM feeds them the information that they need in order to be able to support customers. So seeing a lot of applications, both in terms of building product, as you described, but also in terms of leveraging that into the enterprise, into companies to help those companies run more efficient businesses, which, as we know, has been a little bit of a theme for this year. As we think about, the Wright brothers sort of taking off and like the extra mile, let's turn to sort of another flyer. This time, one of my favorites, Spider-Man, good old Peter Parker. And, one of the things that he said that I've always found quite compelling is the notion of with great power comes great responsibility. And there's no more, I think that's no more apt than when we think about AI. And so, a lot has been talked about the risks. And one of the things that we've been thinking is part of our prediction for this coming year is that we'll combat AI risk with AI. And so perhaps, Ryan, you could elaborate a little bit on that.
Definitely. Love that franchise. So if you can get a Spider-Man reference in a work context, it's always a good day. I want to tie a little bit of the last point into this point. As recently as 10 years ago, we would hail a cab the same way we hailed a cab in the 1920s. You would wander aimlessly in the street and raise your hand up and hope by some dumb luck the cab would arrive for you. And with the advent of ride sharing, it was sort of reimagined completely. Like, forget what happened in 1923. If you reimagined it completely and knew where every vehicle was, is there a better network affected way to deliver this? And of course, we see the advent of the ride hailing market. I think AI will have similar look back moments of like, oh, aha, we never should have done it that way. It should have always been employed leveraging these AI skills. And so when you start talking about the responsibility of it, there are two forks that come to mind for me on threat vectors for AI. One is, who is the arbiter of truth? And if AI is saying something is true, who determines if that's true? As an aside, we have a hard enough time with the truth without AI cluttering it. Notions of those are your facts as sentences that are stated, when facts are supposed to be facts, not open to debate. And so the who sets the truth is a major question mark on AI. And yes, you could have AI solutions checking the AI answers to make sure that we're looking back to source data and ensuring that there is actual evidence, or at least a watermark of this was not human vetted. Something to that degree is one major dimension of what is truth. And we all see the power of propaganda in many, many aspects of the world. It's important to understand that dimension of it. Most people would think of the other prong in the fork. How can I leverage AI as a threat vector to commit cyber attack? And we've been using cyber capabilities in our infrastructure portfolio using AI ML for a long time. Simple things. I like to use the analogy. If your refrigerator is hooked up to your network and it's trying to delete your entire hard drive, that's not a normal refrigerator behavior. We have solutions like Armis or Plume that would detect something like that and say, timeout, you're quarantined, get away. Because it's thinking like, what is a refrigerator supposed to do? How do I stop it from being a bad actor? If you amplify that with the potential of AI, you're going to want AI police protecting against AI bad guys somewhere in your tech infrastructure. And so we certainly expect more emergent business models leveraging AI from a protection standpoint. And I suspect a lot of the behavior will be like I described. What is an unusual / unacceptable behavior, and how do we protect against it? So those are the two big threat vectors that I think about. There are many, many, many more, but arbiter of truth and keeping your data and information secure.
Yeah, I think, predictor number 3, Ryan, as you said, is, unethical models of AI will present a massive cybersecurity risk. A recent CIO poll showed that 85% of CIOs say that AI is already powering many of the cyber attacks that they're receiving. And this is one of the things that we are very much aware of and investing behind and looking at in terms of like really going back to our very first point around productizing AI. How do you create an application on top of something that is an open ledger or an open platform? The apps are the ones that really seek to combat certain types of behaviors. The world that we live in has been unpredictable. Certainly, let's go back to 2020, a world in which the pandemic unfolded. We all learned how to work from home. In fact, most people are still not fully back in the office, so we haven't fully returned to normalcy. That inability to work or to travel created for us in the VC industry an environment in which the deal flow accelerated because we realized we could do deals on Zoom. We didn't have to get on planes, at least in that era. And that created this artificial sense of supply and demand, especially since there was a lot of supply of capital looking for great places to invest that had a return, that had growth, and the tech industry was definitely one of those. And so, Ryan, we've had a couple of years of consumer demand being pulled forward because of the pandemic, and then we've had a couple of years that are followed by this market correction. When do we get to normalcy? What do we think is normalcy? What's your point of view around how do we view 2024 relative to the last 3 or 4 years?
Yes, I could fill the whole session on this. And the fun part of predictions is I know they're all wrong. I just don't know how much. Is it faster or slower than we say? And I'll hit this now, but Hilary, I want to come back to something you said about AI a moment ago, but I'll do that after I answer your question. There was a question that came in, and I want to hit that too. It's been a really hard time. 2019 feels like an eternity ago. 2020, of course, was the COVID year, and we all dealt with physical safety from a health perspective in a way that certainly the entire nation and the entire world's never gone through at the same time. So everybody kind of had that common experience of fear for physical safety. That creates distress. There was all the market consequences of that. How you felt on March 15th, 2020, when the market was plummeting, worried about your financial security. That's not a good feeling. And then we had, starting in July, this euphoric rise of what became the 2021 bull market for tech, which was a somewhat euphoric adoption of tech, where demand signals were so distorted, it became clear in 2022 that maybe there was some overbuying, and maybe the capital wasn't supposed to flow exactly that way. And of course, inflation, our old friend from the 70s, came back for the first time in many people's investing careers and operating careers. And we had to deal with rising interest rates, having gotten used to near zero as normal. When if you look at any chart, 5% is kind of where interest rates have been for a really long time. It's really a post.com bust phenomenon. And it all really comes back to tech. Tech helps increase productivity. Increasing productivity necessarily keeps inflation down. So we've lived in this period of low inflation in part because of the promise of increased efficiency, all because of the accessibility of technology. So we, the players in software, everybody on this phone call, we are the ones that can create the inflation to go back to a normal place. We saw an incredible increase in money supply, which definitionally must lead to inflation. And we're finally seeing, if the Wall Street Journal is correct this morning, inflation indicators are coming back down. But all of the years, 2020, 2021, 2022, 2023, grossly distorted by something. COVID, anti-COVID, inflation, come down, readjustment, all that stuff. As you look ahead to 2024, there's a debate as to when the Fed might cut. There's not a fear of unchecked increase, but there is an expectation at some point in the year rates come down, which relieves some of that pressure. The economy is held up. GDP is coming in hotter than expected. That's a good thing from a pure macro perspective. So we have a shot, a chance that 24 is a most normal year since 2019. And the expectation when you typically wake up on Jan 1 is this is going to be a normal year. Obviously, there are geopolitical challenges in the world right now that are at risk of creating some other macroeconomic event. And of course, just macroeconomic bad things can happen at any time. But from where we sit, there's a chance, and man, I hope it happens, that 24 is more normal. And that leads to a lot of better behaved capital markets, which I know is going to dominate the next chunk of this. But if it's okay with you, Hill, can I back up one half click on the
let's answer the question.
There was a question on the cyber AI risk and do humans still need to stay in the loop? And I just feel that there's a need to express AI by Hollywood, like Terminator, Matrix, like Hollywood AI, is very different than the AI that exists in all of these applications. I think it's a gross misnomer. Mm-hmm. It's not really intelligent. It's got incredible compute power. Imagine 10 million iPhones like jammed into one thing, able to do calculations. It's only doing what it's designed to do. It's a very, very fancy and sophisticated regression, and it translates those numerical answers into words we can understand or words a computer can follow. It is not sitting there thinking on our behalf. It's facilitating us. And so for this version of AI, the human is necessary to tell it what to do, interpret what it's doing, or guide it. And I want to reinforce that centaur concept where I have a half kind of machine, half human. That is really the expected case, certainly in 2024 and in the near term. So you're getting the best together. And it's going to be coincident as this emerges with this need for more efficiency that we're talking about in this topic of how do we kind of get out of this really odd moment in time where everybody expects soft landing, it's hard landing, it's terrible landing, it's soft landing, maybe it's okay. This gyration is because we've never had a pandemic plus a tech revolution plus interest rate mastery. They didn't have these tools in the 1920s in the Great Depression. So we're writing history in real time, and it will be so clear what's right, so clear, but only after it happens. And that's just the way it works in our world. You only know you're wrong until it's abundantly clear, and you hope you're right for as long as possible. So I know I've hit a lot of ground. Tell me where you want to go.
AWS, just to pick up on that, at the AWS reInvent conference last week, I think there was a bit of a shrewd summary of kind of all the conversations around this topic. And I think it hits on what you're just saying, Ryan, which was that, while AI will make predictions, human beings will make decisions. And that is a really great sort of dichotomy of, we need the AI because it helps us be more productive. And as you mentioned, productivity keeps inflation low, creates opportunity, creates more output, but it's the humans ultimately who are going to make the decisions. And so as we think about human behavior in a world in which we're going to potentially return to normalcy, and we're crossing fingers that we get there, what does that look like from a deal flow, deal making perspective? We know this year the private equity market was kind of turgid. There was just such a difference between bid-ask spreads that there were just no deals happening, partly because of interest rates and some of the more macro pictures. And then we know on the VC side, companies had lots of money. They had raised money in 2021, and based on their own instincts as well as the guidance from their investors was preserve cash at all costs. Make sure that you extend your runway. And so we haven't really seen companies need to come back in droves yet to raise rounds, and we haven't seen any new rounds in the private equity world. And so if you think about normalcy, what in your mind does that mean for the PE world?
Yeah, you touched on some of it. Everybody wants more capital all the time. Like, everybody wants to sell their companies for a great outcome all the time. There's not always available capital, and there's not always available buyers. And so a lot of the phenomenon we've experienced in lighter deal activity is really born of just the fundamental reality that sellers have really sticky memories when prices are falling. Sellers want yesterday's price if today's price is lower. And buyers have an immediate memory of current conditions. And so when you have a dislocation from a value perspective, it creates this mismatch. Sellers believe the market will come roaring back. Buyers believe it's never coming back. And until somebody's right, you're stuck. There is nothing to sell. There's nothing to buy. You're just stuck. And we've been just stuck. Generally, it doesn't land at the pole. It's not all the way at the bottom. It's not all the way at the top. There's some new equilibrium established. And my shorthand of a should return to normal is there should be a partial revelation on both sides that it may not be as high as it was. It probably shouldn't be as low as it is. I need to do something for whatever reason. From a fund, we all have DPI obligations that we're aware of. If you're a founder, who knows what issue you may be thinking about your kids' tuitions. You may be thinking about just diversification, having lived through the past 4 years. Everybody has their own reasons for transacting. Nobody wants to sell into a terrible market. No fund wants to run out of money in a known challenged fundraising environment. Like, all of these factors are dependent on a reasonably forecastable amount of liquidity in the system and a reasonable amount of investment forecasted in the system. And that got disrupted badly in the past 4 years. Too much in 21, too little in the past 2 years. The normalization of that really helps drive all of our expectations for how we think about capital allocation and what to do. So I do expect we're just out of time as an industry. Can't sit on your hands forever. At some point, those balance sheets get closer to zero. At some point, the ticking clock for realizing returns is too loud to keep holding. That's all lining up. And maybe it's not January 1, 2024, but sometime before now and the end of the year, I expect to see a lot more. And we're already seeing an uptick in deal activity. So they're all interconnected themes. I'll let you probe on which ones you're most focused on.
Well, I mean, let's talk specifically about M&A. If I'm a scale up, I'm contemplating a next raise. How should I think about, is M&A the right next move for me, to be acquired by a strategic, to combine with one of my competitors, to create more market heft? And likewise, I know, when we invest in larger private equity type deals, those platform companies are looking for amazing technology to add to their platform for the various reasons of let's get greater share of wallet from existing customers. Let's leverage the same sales channel that we have so that we can sell more through that same channel. Yeah. So if we think about M&A, both from a scale-up startup perspective as well as from a platform company perspective, and then the third is from a strategic. Strategics have also not been active in the market this year. How do you think that plays out? Where's the balance of probabilities and preponderance of deals?
Yeah, no, I think there are an enormity of companies that were created, funded, and trying to do the best they can at relatively small scale, just an enormity of them. And if you think about your options, the IPO market remains challenged at best for subscale companies, especially. There is no IPO market for subscale companies. And the big strategics aren't likely to buy subscale companies, very rare exception. But the subscale company, if you have a challenged capital raising story, if you have a challenged product market fit set of questions, the likeliest answer to that is a bunch of close enough examples of those band together and become a much bigger scaled collection of features as opposed to a single feature or a platform, like a collection of things big enough to be a platform. And so when I see that prediction, I think more of the private co to private co combinations, maybe not for liquidity, maybe for stock. We're seeing a huge uptick and at least ideating on that, even inside of our portfolio. Like, does this 1 + 1 or does this 1/2 + 1/2 equal more than 1? Like, how do we kind of create options for companies that aren't strictly limited to I sell to SAP, Oracle, or some big company, or I take it public? Are there private company combinations that make sense? And so I think we're going to see M&A at a much, much smaller scale inside of growth companies in a way we hadn't really seen before, because there will be an excess of companies to do this with and a lack of capital to catch up quickly enough. So yes, I expect M&A activity for the sponsor market to be higher. Yes, I expect M&A activity for the big public companies to be higher. But I think by count, this will be one of the more interesting things to watch as otherwise potentially stuck companies take a not so good potential outcome and can create 3, 4, 5x from that point by joining forces with something much bigger. I hope that happens because it's good for both sides, both the selling company and the acquiring company.
Yeah, you and I both sit in board meetings, and this time of year we're very much thinking about board planning, budgeting for the next year, and there's obviously thinking around what's the demand side of the equation going to look like, and how do I match the cost side of that equation to drive unit economics that are efficient. And when you're sitting in a board meeting, what are the conversations that you're having? What are the ways in which you're guiding both board members sitting around the table as well as leadership teams around how to think about that kind of planning?
Well, you probably wouldn't be surprised that AI comes up a lot. I know we have our 45 minutes and there are a couple more AI questions we can debate if we go back to AI, but this is a bit like the boardroom. You move down the line, like, what about AI? And you end up right back talking about implications of AI. That's clearly a topic. And one of the topics embedded in that is AI a net friend or a net foe? And the answer can't be none of the above. Like, it's got to be one or the other. And so either get busy protecting against the risks or get busy building it to be better. And I used the content management company Optimizely as an example earlier. If we failed to have a good AI solution, it could open up a threat vector where it's not the AI that's the problem, but if somebody else's solution has a shiny AI object and we don't, maybe that churn flips to them. So think of the AI opportunity as churn mitigation or retention maximization, and it's really important for that. Capital is a big one. If there's misalignment on the board as to what to do about capital, that conversation has to happen. And every company is a little different. I think the alignment concept is what's universal. When we're sitting in a boardroom, we're asking ourselves, do I have affirmative alignment with the rest of the investors and management? Or do I need to create alignment with the rest of the investors and management? And if the answer is I need to create alignment, that typically can't happen in a boardroom. That happens one by one by one by one. And so in the boardroom, you focus on the things that are the easiest and most obvious. The unit economics may appear to be decaying. Make sure that's something stated. Or there may be this massive M&A opportunity. Let's flash back to our previous comment. how about we dip our toe into M&A? And at Insight, we've got the whole onsite team. Obviously, you built it, right? We can help support you in M&A, even if you've never done it before. So how do we encourage companies to maybe take new risks as we maybe dip out of the bottom? It can be all over the map, but the number one thing is what is the likeliest opportunity for us for a good outcome? And how do we get alignment that we're all pulling in that direction together, everybody on the board and management? That has a lot of different ways to manifest, but that's the most critical element of our role in a boardroom.
Yeah, one of the things that I've been thinking a lot about recently is, for those on the call who are LPs, but also for those who are operators and founders, leaders, when we're sitting in a boardroom as investors, what we're thinking about is, do I believe the story that I'm hearing? Do I believe that there's a narrative here that makes kind of economic and kind of industrial business logic? And can I sell that story back to my partners if this company were to need more capital? And how do I tell the story that justifies the valuation that I mark this business at? Because, we need to be believers, and we need to believe that, what we're hearing is not, and I think you alluded to this earlier, but a lot of companies got funded, Ryan, that I think were, maybe features that should have been part of a product. And maybe some products got funded that should have been part of solutions. And those solutions potentially, or should be part of a broader platform or a broader franchise. And that's where we're kind of getting back to the M&A. But getting back to the story around, how should I be, thinking about it as a founder? What is the advice you would be giving founders as they approach this coming year?
Yeah, I mean, first, do you have enough cash? Because if you have enough cash, you always have time. So I'm going to stipulate that they have enough cash to make this question easier to answer.
For sure.
What do you want to do? Like, what do you think is possible? And the hardest part of being a founder is, by definition, founders are an optimistic bunch. You can't be an entrepreneur and not be optimistic. You need that as a critical element to believe I can do the impossible and make this thing. So if you're listening and you're an entrepreneur, I congratulate you. You've done the impossible. You made your thing a thing. But now, okay, now what is really the question? I think founders should be asking themselves the same thing I alluded to from our seat in the boardroom. Do I fundamentally feel like there is alignment on what I want to do with this business and what I'm being guided to do with the board? And if you feel like there's not alignment, I think the conversations should be one by one. Where do you feel the closest alignment? Start there and get their feedback for it. Where do you feel the most distant alignment? Call it out, like have the conversation. And sometimes it will be a perception of misalignment, and you'll be able to get a more powerful connection and relationship quickly. Other times it's a very rigid misalignment, but at least you'll know, and you'll understand the parameters of what's possible. And you alluded to, when you sit there and investors, kind of, do I believe in this? There's 3 levels you need to believe with. You need to believe with your heart, emotionally, do I think this works? You need to believe with your mind, like, okay, do I see like evidence? You need to believe with your eyes, like, do the charts reinforce what is possible? And if one of those isn't true, that may be a place where there's misalignment. It's like, I don't see the uptick in your new business activity, and the response could be, I believe it's going to happen. You have to trust me. That's okay. Maybe I can't see it with my eyes yet, and you believe it, and we understand the stepping stones to get there. That's what I mean by alignment. Like, what am I worried about? What are you trying to do? How do we drive alignment? So if you can get alignment as a board, even if it's not perfect agreement, it's at least alignment. It's a healthier dynamic, especially in these choppy moments. And some of it is the misalignment, may be economics. You may have a post-money valuation that's much, much higher than the likely current price. And you're looking at the implication on where management options are in or at the money. Well, that's misalignment. And that's a conversation that probably needs to happen if you think the right answer is a faster liquidity event. It's things like this. They're hard subjects, but open transparency and dialogue, at least from our perspective, is better than silent awkwardness. So I would encourage drive for alignment and have the conversations. And if there's disagreement, at least you know.
Yeah, it's a great thing. One of our colleagues, Devin, I think he has a great expression. He's like, when it comes to doing an M&A transaction, when it comes to having misalignment, sometimes actually having a deal in the hand is a forcing function. And Devin has often said things like, if you want to do the deal, first get your kid into college, then figure out how you're going to pay for it in a way. And a little bit a sense of like that, let's figure if there's a deal to be done here. And then let's figure out, how we can make the the boats all align. Specifically, things like carve-outs, making sure management's made whole if they're underwater, making sure that all of investors around the table are incented along the right lines to establish the right outcome. I want to go back, Ryan, to a couple of these Q&A questions. There's some interesting ones that are coming up here. We've talked a lot about an IPO, about M&A, but what about the IPO window? Is that something that is, a 2025 thing, or do you start to see that emerge later this coming year?
Yeah, I'm going to say something a little controversial. I never liked the notion of an IPO window. IPO window is always available. No one likes the price. It's the exact same dynamic as the window we talked about for buying and selling companies in the past 2 years. We could have sold companies. Any company we wanted, we could have sold for $1, but they weren't for sale for $1. And the IPO markets are somewhat similar in that there are buyers and sellers. And when you go public, you are subjected to the then prevailing multiples for all time. And so the incentive to go public where multiples are gyrating and you're not sure of the macro uncertainty is not a great time strategically to go public. Because remember, when you go public, and I'm speaking now from the investor perspective, when you go public, the earliest you'll see actual liquidity is at least a year out, if not longer. And so an IPO is the beginning of a liquidity journey. It is not an exit. And that concept is really, I think, misunderstood in most of the literature of talking about exits. The IPO is not an exit. It's just a more complicated and fraught with peril liquidity event for the company. It gets cash and liquidity, but then you've got to operate on a tightrope. By the way, it's the absolute best way to achieve peak value for a company because everybody then can make their individual decisions. So there's incredible merits to it, but it's really hard. And one of the challenges of 2021, a lot of companies accelerated their path to IPO. And so we had, in effect, empty classes. The 2022 class and 23 class, well, they grade skipped and went public in 21. And the 23 and 24 classes are trying to defer. They're repeating the 8th grade because they don't want to be in there just yet. At some point, there's equilibrium. And of course, the value regime matters. When the SaaS, you pull out the top 6, 7, depends what you call them. They used to call the FANGs, the Magnificent Seven, whatever you call the bigs. You pull those out of the NASDAQ and look at our comps, we're still down some 30-odd% from peak. And so I think getting a little bit more stability in the SaaS marketplace, in the mid-market where we all play, is a necessary ingredient to encourage more people to get out there. That might happen by the end of 24, but I'm not sure there's any major catalyst and rush. I expect much, much more sponsor activity, private equity activity, and much, much more venture activity long before the IPO market kind of rages back. There'll be a couple deals that happen, but in the $100 million of scale companies, I'd bet at the earliest, very late 24, and I'm not placing a lot of money there.
Yeah. And to your point, Ryan, whether companies, and only a small number of companies are ever going to be IPO-able, as it were, and even a smaller subset of those want to IPO for all the reasons that you mentioned. So sort of backing up, even I'm just looking at a comment here, a question here is, do you think investors are going to be courageous in the sense of, even before there's an M&A deal on the table, they're going to start talking about management teams around creating a carve-out in case of, as opposed to in response to? There was a question that came in around that.
Yeah, look, I think we need to be open to both. Obviously, if a deal comes in, you've got to be reactive. But if you're sitting as an investor, frustrated about misalignment, and the unspoken elephant in the room is, well, the misalignment's because I'm out of water until I triple value, and I'm not doing anything until I know I'm not totally underwater. Well, then it needs to be more proactive. And so, Hilary, this one comes right back to the alignment point. And I'll tell you, you can't be aligned if you don't try to be, right? And so if a deal offer comes in, it's going to smoke it out. It's a little bit harder to be reactive to this because the timelines, the buyer is not going to sit there patiently waiting forever as you manage your intra-investor or intra-management issues. So I would look at how far away are you? Likeliest current value. How far away are you from your last post? The further away you are from that, the more likely this is a conversation that needs to happen if there's a chance of an M&A deal soon. And if you're close, you're knocking on the door of the next capital raise. Just how do you have the discussion in the most constructive way.
Yeah, makes sense. I've got one last question to follow up to close out here. It's a question that came through around tech always talks about addressing the largest societal problems and being front and center in really driving the wedge in kind of new innovation and thinking about ways to improve, the betterment of society. But often, well, a lot of what we're doing is just incremental. At least that's the criticism that gets leveraged or levered at what's your point of view around where and how investors think about where to put their money, Ryan? So is it that they're shying away from these really thorny problems and just trying to do some low-hanging fruit, incrementalize things, or are investors really willing to take risk? And I think a lot of that comes back to the question around risk reward.
I think investors by nature want to take risk. They would call it sure thing taking if it was a short. It's not sure thing taking. This entire line of work is risk taking. The debate is about the cost of risk. And so again, these multiples always come back to haunt you. If one person thinks 10 times ARR is the ceiling for valuations forever, they're going to have a very different view on current value than if somebody else feels like, no, 20 times is constantly reasonable. And I think we're going to get to 20 times again. And so there's just it's the mismatch that affects cost of risk as the appetite to take dilution. So I don't know that there's any fundamental change in the desire to place bets and to make investments. There's a very different landscape of where am I getting my next dollar to invest, because the LP community needs liquidity to refill their coffers so they can refund new funds. The liquidity has been down. So like all of this stuff is interconnected. And when you have such a violent dislocation as we had in capital markets, it takes a little bit of time to rebuild. So I think it's the rebuilding that's the problem, not the desire. I expect inventory of companies to go up quite a bit. And so we'll see. It may look a bit like the housing market, honestly. Housing market's propped up right now by limited inventory for sale. Maybe when a lot of inventory is for sale, we're going to see a lot more activity. It's really hard to say. But you talked about the technology's effect to improve society. I don't know. We can look at social media has not likely improved society. All the studies on impacts on adolescents, it's allowing like-minded people, including like-minded people with really not good things to say or not good feelings to have, amplified in their groups and connecting with each other in a powerful way. So I think there are some underbellies to technology, but one thing technology does unequivocally and powerfully is it increases the individual productive capacity of every individual. And I'm going to come back to this GDP growth concept. I learned this very early in my undergraduate career. GDP growth is population growth times productivity growth. That's it. So 1 plus G plus 1 plus P or whatever you think. That's it. And if you do it on a real rate, you divide out inflation. And so your real growth rate is strictly capped by the expansion in population. Think immigration as an impact to that, right? Strictly capped by your population growth plus your productivity growth. And we, the software community, are the thrust for that productivity growth. That I believe unequivocally, but there can be consequences. There are some questions we didn't get to on safety of AI and making sure we're keeping up in the AI arms race without getting too far. I think the human in the loop question is really at the center of that. You start putting no human in the loop on missile defense systems. Okay, maybe Skynet really is a thing, Terminator edition. You keep humans in the loop and maintain ethical standards, we'll find the right boundaries for it. So we're going to learn a ton in 2024 on the hot buttons in AI and what it means for all of us as individuals and for our companies.
Yeah. And, I'll go back to the Charles Dickens quote, which was 165 years ago and is equally as apt today. So we started this by saying, it was the best of times, it was the worst of times. Our premise is that it's neither of those. That quote goes on to say, we had everything before us, we had nothing before us. In short, this period could only be talked about in comparison. And so I think, as we talk about 2024, we're going to compare it to 2023. And I would leave everybody, with the notion that, we have everything before us. There's the promise of AI. There is the promise of what technology does, as you say, Ryan, in terms of productivity, and then, in terms of societal change. So thank you everybody for joining. I'd encourage you to actually look on our website. We produced a much longer version, probably a much more comprehensive and rational way of describing this, exactly these predictions. We put them on our blog yesterday, and so if you want to read more about our predictions, feel free to go to insightpartners.com. And with that, I will hand back to Deanna. Thanks, Ryan.
While she's coming back, I'll accept not best of times. I'll accept not worst of times. I just want easier times. And that's my holiday wish for all of us. We get easier times.
Yep.
Because pandemics and inflation and wars and all of this, wouldn't it be nice if we get a little bit more normal in 2024?
Absolutely. Here's to normalcy.
Thank you so much, Ryan and Hilary. It was awesome to hear your guys' conversation. And thank you everyone who joined. Thank you for your comments, your questions in advance. I hope everyone took something away. I'm going to echo what Hilary mentioned. We just released our 2024 predictions on our blog as well. So I linked that in the chat. We'll also link it in the follow-up materials. So stay tuned for the recording, and please take the survey. And thank you again, everyone, for joining us today.
Thanks all.